Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik. Today it is my pleasure and a privilege to welcome back a really good friend, Chris Miles. Hi, Chris.
Hey, Mike. It's good to be on again.
Thank you kindly for coming on the podcast. We'll skip the pleasantries. We have very limited time, so we'll record this episode, kind of go straight into the meat and potatoes of infinite banking. So what's happening out there today? We're in a high interest rate environment. How is infinite banking looking? What is happening? What's new?
I tell you, infinite banking definitely looks better than normal banking right now, especially with, we got Silicon Valley Bank, Signature Bank, we got Credit Suisse. I mean, we got all these banks right now that are having issues. And as much as Warren Buffett wants to say, hey, my Bank of America stock's just fine, you guys should keep investing in banks, it does cause you to question, right? So the number one question I always get is it safe to invest, or not really invest, but save money inside of life insurance policies, right? Specifically whole life, like we talk about with infinite banking, stored in there where it's a tax-free supercharged savings account versus keeping in the bank. And the answer is really the same as what I've been teaching for several years, which is, like in my example, I'm definitely teaching people to be more liquid lately, right? Have a lot more cash, more dry powder on hand, because Mike, it's starting to get frothy out there, or it's just getting to that point. Like we're starting to see those little deals. Like you showed me a distressed deal that you guys have in your fund, right? I mean, there's deals starting to pop up. And so being liquid with cash, I think is going to be essential, because I think we're going to end up going into a liquidity crisis where there won't be as much cash. So having cash, those that have cash will be king. But you don't want to store cash in the bank, especially too much, because what if the banks start failing? What if you have issues where FDIC can't cover it all? What about the fact that banks don't pay that much anyways, right? That's where infinite banking has become a good resolution. In my case, my wife wants to keep $300,000 liquid that we don't touch. That's our emergency fund. Well, that's not going to make a lot in the bank, earning 0.nothing%. And not to mention, I get taxed on that 0.nothing% at the bank. So what I've done is I've actually moved more of my money, or kind of earmarked more of my money inside my life insurance, the cash value, which is the savings account, the tax-free savings account inside of life insurance, not death insurance, not the death insurance part of it, but the life part of it, the savings part. I keep about 240,000 plus there, while the other 50, 60,000 plus I keep just in the local bank. So I'm not overly leveraged in the bank. I've still got money there that I can access that day, but I've got the majority, the lion's share of my money, my reserves held inside the life insurance. Why? Well, one, they do pay between 5 and 6% tax-free right now. Some of them are starting to push up towards 6%, because as interest rates have gone up, it's also driving up their dividend rate that they pay you. Secondly, they're safer than banks. In the Great Depression, there was about 36,000 banks in the 1920s. And then all of a sudden, after the Great Depression, there were only 13,000 left. We basically lost 2/3 of banks that went out of business during the Great Depression, where with life insurance companies, only about 4 went out of business. So a drastic difference. And the reason is because they're not over leveraging like banks are. Banks are trying to lend out money. They're investing in different types of T-bonds and bills and things like that, that may not perform well, and they can lose a lot of money and become over leveraged. They take a lot more risks. Where insurance companies don't do that. They have their money, they go and put it into secure products, secure type of investments for themselves, and you get paid from that. That's why the guarantees are always at least 3%. And that's if they don't pay a dividend. That's just what they are contractually required to pay you. So, when you're getting, those kind of stable returns, and they have a better business model. And on top of that, even if they do happen to go defunct in that rare case, they also have to buy reinsurance, which means there's global insurance companies that also insure the insurance company. So if they ever become defunct, those reinsurance companies step in, make sure your cash value, that savings account, and the death benefit too, both of them are protected, that you don't lose any of those things, and your contracts are remaining in force the whole time. So that's why I have a lot more confidence in these things. Not to mention, of course, I can use it like a Roth IRA, but without all the limitations. It's tax-free, gross tax-free, comes out tax-free, if lawsuits, or creditors, if they ever happen to sue and win, they can't touch this money in most states. We have 100% protection. Even if you have millions of dollars in here, they can't touch it. You can use it to show cash reserves if you're getting a mortgage, but at the same time, if you ever apply for college, they won't count it. And so they don't count as an asset. So you could, again, have millions of dollars sitting in there, and the colleges will still give you financial aid because that does not count as an asset to them in their eyes. And same thing with the IRS, doesn't tax it. So for me, it's been a great place to store that dry powder. And even when I'm having people fund it, I don't have them use their investment money because I'm an investor too, right? I don't have them use the investment money up front. I just have them diversify their emergency fund into that over a couple of years, start to rebalance it, right? And then it also keeps the cost down. You get a better ROI on your money. And eventually it becomes like what I call it, a tax-free supercharged savings account.
Yeah, thank you for that. That was awesome. That's a lot of great nuggets, and I'm completely on board. It makes a lot of sense. It is great asset protection. Your life insurance is not you. It grows at the interest rate higher what the banks are paying, especially big banks. What's really annoying is in this environment, these small regional banks desperately need deposits, so they actually pay decent interest rates. But people don't want to keep the money in them. They're nervous about those banks. So the capital has fled small and regional banks into the big banks, and the big banks are not paying anything too exciting. So from that perspective, it's a challenge. And you're right, life insurance companies are a lot more stable than these banks. These banks, their entire business is sort of they operate on demand deposits. They can get a call for liquidity overnight, and the only thing that'll keep them afloat is if the Fed provides discount window cash. Beyond that, they could be in trouble. And many of them have actually damaged balance sheets because they bought U.S. long duration treasuries.
That's right.
And the interest rates increases basically reduce the value of those investments. So if they have to sell those bills, treasury bills, they'll have to realize losses. And by the way, that's in fact, or a portion of it, what triggered Silicon Valley Bank collapse. They had to run the bank, they had to sell treasuries, they had to announce big loss, and boom, the whole thing kind of imploded. So what you explained makes a lot of sense. So, and by the way, I heard this statement that finally life insurance companies actually making a profit in this high interest rate environment, because life insurance companies actually need high interest rates to earn a decent return on the money that they're paying you. Like you said, they're paying you 5 to 6%. They need to earn securely. I don't know what the exact spread, but higher than that. So the high interest rate environment has given them that opportunity, and they're actually generating better profits. So in fact, they're even safer now than before, and it makes total sense. So any other quick thoughts on how would folks take action today? I mean, if they're sitting on cash, they're nervous about where to store the cash, if they see a limit or not. Theoretically, you could keep your money in a small bank, right, up to $250,000. So that exists. But at the same time, having a policy set up, it's almost lucrative because you can actually borrow from the policy. And when you borrow from the policy today, what interest rate they charge you? Is it the same as before? Or they start?
It's pretty close to the same. Each company's different, but most of them are right around between like 5 and 6%. So similar to their dividend rate. Give you an example, the dividend rates for like the two top companies I use are between 5.75 and 6%, and they're predicted to increase 2024, 2025 because rates have been been up higher than they had been in 2020. So you're going to start to see those go up. Loan rates are right about the same thing. Usually right around 5% or so is what you'll see on a loan rate too.
Well, it's almost you're going to laugh at this. You could, in case you can open a policy, jam the cash in the policy, borrow against the policy at say 5%, and literally jam that cash back in the U.S. Treasuries. You're not making a big arbitrage there. Like U.S. Treasury is probably paying the same. But the point is, if you wanted to get access to liquidity, it's there. I mean, at 5%, it's a great cash, and if you find a great deal, lets you keep the reserves, lets you keep dry powder, right? All those things are great benefits.
Yeah, I actually interviewed a guy, you might know him, Eddie Wilson. I interviewed him on my show recently. He's been working with our company as a consultant, and he grew up, his grandfather had owned a bank, and then also his best friend, who's kind of like his rich dad, also owned a bank when they was growing up. And he was taught from a young age that using life insurance for the banks was actually huge. And they would use it similar to what we talk about here, where they would use it as a way to create more leverage, right? Because they would get those policies, They could store cash in it. They know they're making like 4 or 5% or more tax free on that money. And that also allows them to leverage and be able to get more money because it's a better tier capital that they can use to lend out and get more money. So they're able to get that. I mean, they get a better double dip effect than we get as just normal Americans, right? But definitely that ability to earn returns in 2 places at the same time is one of those unique features that you have. But you can't just do it with any normal whole life policy. So if you're looking to take action, I would give 2 pieces of advice. One is don't just dump all of your cash in day one, like in year one, because you do that, it's going to drive the cost of that policy up and eat away your cash more. So you want to make sure you're careful with that. And that kind of leads to number 2. It needs to be properly designed. And that really comes from the agent. Just the other day, you and I are in a mastermind group together. One of those members said, "Hey, talk to my son. You know, he was at that next generation event. He's in his 20s. He's stable now in his career. He wants to know how to leverage this." And he talked to his Northwestern Mutual agent and wasn't impressed. And I said, no, because Northwestern Mutual is so expensive, you'll pay more to their company profits than you will to your own profits. So I said, no, there's better things. As an independent broker, I can tell you there's better things you can do. And so we're chatting about that, of how you can actually make literally hundreds of thousands of dollars more by reducing those costs by that much over the next several years. So that's a big thing. You want to make sure it's well designed, and definitely if anybody ever has questions, you can always either one, check out our YouTube channel, Money Ripples channel, where we have a playlist just on infinite banking, or 2, you can go to our website, moneyripples.com, and we can even run numbers for you, show you how it looks in your specific situation.
Yeah, thank you for that again, Chris. And I concur with you 100%. Don't try to be a jack of all trades and a specialist in your own design of your own life insurance policy. Most folks are better off working with you, and specifically you, not many of the local agents. I made the mistake years ago. I gave the business to kind of a buddy of mine, good friend, a local insurance broker, agent, and they do things very different. They don't think of infinite. They do. So they structure the policies in a very different manner. It still has a benefit. It's just different. In other words,
that's right.
The other thing that I observed is they structure the policies that give them highest commissions. So I hate to put it this way,
exactly,
but the improperly structured policy, or the policy structured to benefit them in the form of higher commission, benefits them but doesn't benefit investors. That's why working with you, and I know from experience, and we have so many mutual friends, that you'll do what's right for the investor, not what's most rewarding for you, because you're trying to build a long-term relationship. And many people will buy another policy in a few years. Kind of they get one policy today, another policy in a year or two, as they have more liquidity. So folks don't need to think, hey, I just need one gigantic policy forever. They can buy 5 policies, right? I mean, what is it called? Laddering or something like that, right?
It's a lot like laddering. It really is. I mean, you can have, really with how we design it, you could probably never get enough death benefit on you, because we minimize the death benefit so that you maximize the cash that grows in there. Where insurance companies always teach the opposite to their agents, which is maximize that death benefit, take all your cash out, so then you barely have any cash in those policies. At least it'll take several years before you have any cash, but that just pays the agent and the insurance company more, but not you. And so what the strategy that we use is something that really insurance companies don't encourage people to do, because it kind of milks the system, right? It just, and that's always our promise. Like we call it max ROI, infinite banking. That's our promise is, in whatever the situation or scenario is, we'll try to make sure you get the best ROI possible, hands down, compared to anybody else out there.
Thank you, Chris. Appreciate your wisdom. And this is a particularly short episode. We both had a very limited time, but we wanted to record a fresh update. So I appreciate this update. What's the best way for folks to reach out to talk to you about infinite banking or setting up life insurance policy?
Yeah, like I said, you go to YouTube and go down the rabbit hole by finding the Money Ripples channel, it has a playlist called Infinite Banking on there. Or you can even just go to our website, moneyripples.com, contact us, and we can set up a time to chat with you.
Thank you, Chris. Moneyripples.com. And looking forward, we have to do another episode really soon. So this was very short. We'll dive into some more depth on financial planning, because I wanted to ask you a bunch of questions. What changes do you do working with clients in the financial planning side? But that'll be the next episode. So we'll do another one very soon, and we'll talk about financial planning in this crazy world of high interest rates, the banks failing, and a lot of uncertainty, potential recession. So That's the next one. Appreciate your time. Thank you kindly for coming on the podcast. We'll do another one really soon.
Sounds great. Thanks.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.